webinar, I'll be going to something a bit more complicated than the last two webinars, which was how to get started in investing, opening a brokerage account, and webinar 2, which was on stocks and bonds. So today I'll be talking about ETFs, or exchange traded funds. And I want to spend a bit more time explaining about exchange traded funds because they are a key component in the portfolio that I'm about to share with you that makes up the world's easiest portfolio and what makes it possible. So let's dive right in. So what exactly will we cover today? We will cover what exactly ETFs or exchange traded funds are. We'll cover what indexes are. We'll cover exactly what the STR ETF is. And then we'll re-emphasize again why buy ETFs again. So let's move on. So a short intro or preamble before I begin is that your own brokerage firms, after creating an account with them, will have free training or introductory courses on investing to help new beginners and new investors get started. So I highly encourage you to go for them and keep learning more and more, even beyond this group. So now let me introduce to you the ETFs, or namely exchange traded funds. So this will be a slightly tougher lesson, and if you have any questions, please don't hesitate to ask me in the group or PM me. So let's dive right in. So ETFs are exchange traded funds. But before we talk about what the whole term ETF means, we first need to understand what are funds exactly. So funds are simply a collection of stocks or a basket of stocks. So instead of owning one stock, I have multiple stocks. So for instance, if I only own $20 of DBS shares and DBS performs badly, then this amount will drop from $20 to $10, and I just lost money on my investment. My $20 invested has now become $10. But if I own a fund of $20 that contains $10 of DBS and $10 of UOB, when DBS does badly and drops from $10 to $5, my UOB shares might rise instead from 10 to 15 based on UOB's surprising good performance, and my total invested amount remains at $20 and I don't lose anything. So that is a very simplistic understanding, but it gives you an illustration of how ETFs are a very powerful investment tool because through diversification, you will not lose as much money as you thought you would if you had invested in a single investment product. So as I just said, this is the beauty of funds or this basket of stocks. The idea of diversification. When one performs badly, I still have many others that perform well, hence I don't lose as much money. So ever heard the very common saying that don't put all your eggs in one basket? Well, this is exactly what it means in investing. Diversification is key. Don't invest all your money in one stock or one bond only, because if that one stock or bond collapses or dies, you are doomed and you are screwed. So ETFs is a very good way of diversification. You buy a stock fund or an ETF, which is a collection of stocks, and this gives you a diversified portfolio and protects you to a certain extent from risk instead of owning a single stock. So now that we know what a fund is, let's move on to explain the whole term exchange traded fund. So an exchange traded fund is a fund that is a collection of shares identical to an index. So this sentence might be a bit difficult to comprehend, but I'll try my best to explain it to you in the next few slides. So first, we need to understand what an index is. Think of an index as a collection of stocks in a certain country. So in Singapore, our main index is the Straits Times Index, or STI. So if the STI index, for simplicity's sake, has two stocks only, 50 stocks of DBS and 50 stocks of Singtel, then the STI ETF, which is the ETF that tracks the STI, will have 5 stocks of DBS and 5 stocks of Singtel. A lower quantity than the index, but a similar ratio. So why then, you ask, is the STI and the STI ETF not identical? Well, because the STI index is just too large. There's millions and millions of shares and trade volume happening, and we can't buy everything and own everything in the index. So what fund managers have done is that they have created a proxy to this index, and it is called the ETF. So instead of buying index, now you can buy the ETF. And the ratio of stocks or the composition of the STI and the STI ETF will be near identical. If the STI index goes up by 7%, the STI ETF that tracks that index will also go up by around 7%. Around because there might be less than 1% of tracking errors, but more or less it will be a similar performance. So just as a reference, the STI ETF has performed around 7% and annualized returns with dividends reinvested over the past 10 years. And that's really not too bad for investment product because you can just buy and hold on to it. And you don't have to keep worrying night after night whether to buy or sell or read this chart or read that graph and analyze until your brain explodes. And we all have better things to do with our lives rather than look at the computer screen every day and checking charts and data. By just buying an ETF and buying an ETF in itself being a diversification against risk, you are getting the returns of the market and getting the returns, in essence, of that country's economy's performance. So I just want to re-emphasize again, why buy ETFs again? Because ETFs are a crucial component. In fact, they are the main component of the world's easiest portfolio and of the passive investing strategy. So you buy ETFs because they are the ultimate diversification investment tool. So the only way of losing all your money in invested in ETFs is if the Singapore economy dies, goes bankrupt, or we go to war, or a nuclear bomb strikes us and we all die. Because you are owning everything, or rather the top 30 stocks, which is what comprises the STI index. So the STI index reflects how well the Singapore economy is doing. If the economy is doing well, the index performs well, and the ETF performs well, and of course vice versa. So you're not trying to beat the market. That is the whole concept of this passive investing strategy. You're not trying to beat the market through buying and selling and timing the market. Because honestly, not all of us, in fact, most of us aren't that good. And we will need many, many years of experience to get to that point to become effective traders. So instead, we can do the things that we enjoy, spending time with the people we love, and we can just leave our money to work for us in a very passive way. And that is holding ETFs because your ETFs will grow with the economy and you don't need to worry about beating the market or losing to the market because you are the market. You become the market and your results are directly because of the market's performance. So exchange traded funds is the main component of the world's easiest portfolio and passive investing strategy. And in next week's webinar, I'll be talking about research and investors all over the world who have supported and have used this passive investing strategy. And this will show you that if you don't want to trust a 21-year-old's words of an advice towards investing, you can trust the amount of research and other investors who have backed up this strategy, this passive investing strategy. And I'll prove to you next week that the amount of research shown, the amount of words of advice given by the top legendary investor Warren Buffett supports this passive investing strategy for retail investors like you and me. And that my words can be trusted because they are backed by research and many, many powerful investors around the world. So thank you so much for listening, and I hope you learned about something new because I know ETFs are a relatively new concept to most people, and I'm sure that many of you will have questions on what exactly an ETF is, how it works, and what benefit does it have. I try to break it down in very simple terms, but I know if you want to go into more in-depth analysis and research of what this is, please don't hesitate to ask me in the group or PM me or just let me know and I will answer your question as best I can. And of course, ask your brokers as well if you do have a current account because they also have a very high level of technical knowledge in these investment products, especially, and ETFs are one of those products. So I hope you learned something new today and stay tuned to next Tuesday, 9 p.m. where I'll be talking about research that backs this strategy of mine and what top investors are saying about this strategy so that I can further convince you that this strategy is something that will work for you. So thank you so much and I hope to see you all next Tuesday.